Hello everyone, welcome to the 206th episode of me learning how to trade in Forex. So in the last episode we went through the major central banks. Basically, every nation or region has a central body that is responsible to oversee its economic and monetary policies and to ensure that the financial system remains stable. The body is called central bank, so these institutions aren't market based and they are not competitive. So central banks keep inflation in line with interest rates. Central bank will increase interest rates to slow growth when inflation exceeds its target, and decrease interest rates to spur growth when inflation drops below its target. The Federal Reserve is responsible for the effective operation of the US economy while keeping the best interest of the public in mind. So in accordance with the 5 key functions, the Fed promotes monetary policy, maintains financial stability, preserves the soundness of financial institutions, promotes the safety of payment and settlement systems, and oversees the consumer protection. The Fed is made up of 3 distinct groups, so the Board of Governors, the Federal Reserve Banks, the Federal Open Market Committee. The European Central Bank does not like surprises, so it generally gives the market ample notice by warning of an impending change to interest rates through comments to the press. The European Central Bank's mandate is to keep prices stable and ensure growth is sustainable. The European Central Bank strives to maintain the annual growth in consumer prices below 2%, and as an export-dependent economy, the European Central Bank has a vested interest in preventing excess strength to its currency because this poses a risk to its export market. So that's what we got up to last time. Now we're on to the Bank of England. So let's get started then. Bank of England. The Bank of England is publicly owned, which means it reports to the British people through its parliament. Founded in 1694, it is often touted as one of the world's most effective central banks. Its mission is to maintain the stability of England's monetary and financial systems. The Bank of England's mission is to maintain the stability of England's monetary and financial systems. To accomplish this, a central bank has an inflation target of 2%. The Bank of England has an inflation target of 2%. If prices surpass this level, the central bank will look to curb inflation. A level far below 2% will prompt the central bank to take measures to boost inflation. So, if prices surpass the 2% level, the central bank will look to curb inflation, so to reduce it. Levels below 2% will prompt the central bank to take measures to boost inflation. The Bank of England also ensures the soundness of the nation's financial institutions, the security of its currency, and a financial system that's free from unnecessary risk. The Bank of England ensures the soundness of the nation's financial institutions. Ensures the soundness of the nation's financial institutions, the security of its currency, and a financial system that's free from unnecessary risk. A financial system that's free from unnecessary risk. The bank's monetary policy committee has 9 members. They include a governor, 3 deputy governors, a chief economists, and 4 outside experts. The committee meets 8 times a year to announce findings and policy. Bank of Japan. The Bank of Japan began operating in 1882. Its mission is to maintain price stability and to ensure the stability of the financial system. This makes inflation the central bank's top focus. The Bank of Japan, the Bank of Japan's, why is that not in caps? Aim is to maintain price stability and ensure the stability of the financial system. Price stability and the stability of the financial system. This makes inflation the central bank's top focus. Inflation is a top focus for the Bank of Japan. As Japan is very dependent on exports, the Bank of Japan has even more active interest than the European Central Bank does in preventing an unnecessary strong currency. Japan is very dependent on exports, so it tries to prevent an excessive strong currency. The bank's monetary policy committee consists of the governor, 2 deputy governors, and 6 other members. The central bank has been known to enter the open market to artificially weaken its currency by selling against the USD and euros. The Bank of Japan is also extremely vocal when it is concerned about excess currency volatility and strength. It meets 8 times a year. The central bank has been known to enter the open market to artificially weaken its currency by selling against the USD. So weaken its currency. So if you're selling it against the euro, so it sells its own currency to get euro and USD, right? That means their currency, there's going to be more. Alright, that means there's going to be more JPY in the open market. So if there's more of it, that means there's more supply. And if the demand keeps the same, then the value of the currency is going to drop. The Bank of Japan has been known to enter the open market, to artificially weaken its currency. Weaken its currency by selling it against the USD or EUR. The Bank of Japan is also extremely vocal when it is concerned about excess currency volatility and strength. The Bank of Japan is also extremely vocal when it is concerned about excess currency volatility and strength. Meets 8 times a year. Swiss National Bank. The Swiss National Bank is an independent bank that is responsible for its nation's monetary policy. Its main goal is to maintain the stability of prices whilst overseeing economic conditions in the current country. There are 2 different offices, one in Bern and one in the other in Zurich. The Swiss National Bank is responsible for its nation's monetary policy and aims to maintain price stability and overseeing the economic conditions of the country. 2 different offices, one in Bern and the other in Zurich. Like Japan and the Eurozone, Switzerland is very dependent on exports. This means that the Swiss National Bank does not have an interest in seeing its currency become too strong. Therefore, its general bias is to be more conservative with rate hikes. So Switzerland is dependent on export, so the Swiss National Bank doesn't want to see its currency become too strong, so it's more conservative towards its rate hikes. Interest rate hikes. Towards its interest rate hikes. So the general bias is that it's more conservative towards its interest rate hikes. The bank has a 3-person committee that makes decisions on interest rates. Unlike most other central banks, the Swiss National Bank determines an interest rate band rather than a specific target rate. The bank's committee meets quarterly to ensure the bank is meeting its mandate. The Swiss National Bank determines an interest rate band rather than a specific target rate. Bank's committee meets quarterly to ensure the bank is meeting its mandate. Important: central banks answer to and act as lenders to their nation's governments. Central banks answer to and act as lenders to their nation's governments. Answer to and act as lenders to their nation's governments. Answer to and act as lenders. Answer to. So when the nation's government asks central banks to do something, the central banks follows the orders. Okay, so Bank of Canada. Canada's central bank is called the Bank of Canada. Its mandate is to ensure stability in Canada's economy and financial system. Accomplishes this by enacting monetary policy, overseeing the financial system, maintaining the value and supply of Canada's currency, and managing public debt. The Bank of Canada's mandate is to ensure stability in Canada's economy and financial system. Accomplishes this by enacting monetary policy, overseeing the financial system, maintaining the value and supply of Canada's currency, maintaining the value and supply of Canada's currency, managing public debt. The central bank has an inflation target of 1% to 3% with the aim of keeping it near 2%. It has done a good job of keeping inflation within that target range since 1998. So the Bank of Canada has an inflation target between 1% to 3%, and aims to keep it near 2%. It's done a good job of inflation within that range since 1998. I just realised I will need to later go to the individual central bank's website and just read all about it and understand what it does and stuff like that. So, since 1998, monetary policy decisions within the Bank of Canada are made by the consensus vote in the governing council, which consists of the bank's governor, the senior deputy governor, and 4 deputy governors. The executive council, which is made up of the governing council and the chief operating officer, drafts the bank's strategic direction. The Bank of Canada's Governing Council meets 8 times a year. Reserve Bank of Australia. The Reserve Bank of Australia's functions are set out by the country's Reserve Bank Act 1959. The bank's mandate is to ensure a stable currency, full employment, and the economic prosperity and welfare of the people of Australia. So the Reserve Bank of Australia functions are set out by the country's Reserve Bank Act 1959. Mandate is to ensure a stable currency, full employment, and the economic prosperity and welfare of the people of Australia. The economic prosperity and welfare of the Australian people. The Reserve Bank of Australia's Monetary Policy Committee consists of the Central Bank Governor, the Deputy Governor, the Secretary to the Treasurer, and 6 independent members. These individuals are appointed by the federal government. The central bank has an inflation target of 2% to 3% per year. The committee meets 11 times a year, usually on the first Tuesday of each month, except in January. The Reserve Bank of Australia has an inflation target of 2% to 3% per year. Committee meets 11 times a year, usually on the first Tuesday of each month, except in January. Reserve Bank of New Zealand. New Zealand's economy and monetary policies are overseen by the Reserve Bank of New Zealand. The bank is also responsible for sustainable levels of employment and a sound financial system. The Reserve Bank of New Zealand aims for sustainable levels of employment and a sound financial system. The Reserve Bank of New Zealand has had an inflation target range of 1% to 3% in place since 2000, yet it focuses on a target of 1.5% in the medium term, which it announced at the end of 2018. Failure to meet this mid-term target could result in a dismissal of the Royal Reserve Bank of New Zealand's governor. Failure to meet this mid-term target could result in the dismissal of the Reserve Bank of New Zealand's governor. Medium term, which is announced at the end of in the medium term. So does that mean since 2018 till now, it focuses on a target of 1.5%, target range of 1% to 3% in place since 2000? The Reserve Bank of New Zealand has had an inflation target range of 1% to 3% since 2000. However, it focuses on a target of 1.5% in the medium term, which announced at the end of 2018. Which was announced at the end of 2018. Failure to meet this midterm target could result in the dismissal of the Reserve Bank of New Zealand's governor. Unlike other central banks, decision-making power on the monetary policy ultimately rests with the central bank governor. Monetary policy accountability and monitoring. The bank's committee meets 8 times a year. Who is the chair of the Fed? Jerome Powell is the chair of the Board of Governors of the Federal Reserve System. As such, he leads the Fed. He's currently serving his second 4-year term. his second 4-year term. So he's done his first 4-year, now he's on his second 4-year. Jerome Powell. Is the Fed independent from the US government? The Fed is an independent government agency, however it is accountable to the public and to the nation's Congress. It receives no funds from the US budget. Elected officials and other members of the government cannot serve on the board of the governors. What is the oldest central bank in the world? Central banks have been around for a long time. For instance, the Bank of England was established in 1694. However, Sweden's central bank, the Riksbank, is the oldest central bank. It was founded in 1668. The bottom line, the list above presents some of the most powerful central banks in the world. Although they may have different targets, structures and meeting timelines, their mandates are generally the same. That is, to ensure the economic prosperity of their nations, to oversee their financial systems, and to control their currencies. These banks often work together to ensure that the global economy remains in check. On to the next one, leveraged trading. One of the reasons so many people are attracted to trading Forex compared to other financial instruments is that with Forex you can usually get much higher leverage than you would with stocks. While many traders have heard of the word leverage, few knows its definition, how leverage works, and how it can directly impact their bottom line. The concept of using other people's money to enter a transaction can also be applied to the Forex market. In this article, we'll explore the benefit of using borrowed capital for trading, examine why employing leverage in your Forex trading strategy can be a double-edged sword. Key takeaways. Leverage is the use of borrowed funds to increase one's trading positions beyond what would be available from their cash balance alone. Brokerage accounts allow for the use of leverage through margin trading, where the broker provides the borrowed funds. Forex traders often use leverage to profit from relatively small price changes in currency pairs. Leverage, however, can amplify both profits as well as losses. So defining leverage. Leverage involves borrowing a certain amount of money needed to invest in something. In the case of Forex, money is usually borrowed from a broker. Forex trading does offer high leverage in the sense that for an initial margin requirement, a trader can build up and control a huge amount of money. To calculate margin-based leverage, divide the total transaction value by the amount of margin you are required to put up. So margin-based leverage equals total value of transaction divided by margin required. For example, if you are required to deposit 1% of the total transaction value as a margin, and you intend to trade one standard lot of USD CHF, which is equivalent to 100,000 USD, the margin required would be 1,000 USD. Thus, your margin-based leverage will be 100 to 1, because it's 100,000 divided by 1,000. For a margin requirement of just 0.25%, the margin-based leverage would be 400 to 1, using the same formula. Margin-based leverage expressed as a ratio, 400 to 1, margin required of total transaction value, 0.25, 200 to 1, 0.5, 100 to 1, 1%, 50 to 1, 2%. Leverage involves borrowing a certain amount of money needed to invest in something. However, margin-based leverage does not necessarily affect risk, and whether a trader is required to put up 1% or 2% of transaction value as margin may not influence their profit or losses. This is because the investor can always attribute more than the required margin for any position. This indicates that real leverage, not margin-based leverage, is a stronger indicator of profit and loss. To calculate the real leverage you're currently using, simply divide the total face value of open positions by your trading capital. For example, if you have $10,000 in your account and you open a $100,000 position, which is equivalent to one standard lot, you'll be trading with 10 times leverage on your account. 100,000 divided by 10,000. If you trade two standard lots which are worth 200,000 in face value with $10,000 in your account, then your leverage on account is 20 times because it's 200,000 divided by 10,000. This also means that the margin-based leverage is equal to the maximum real leverage a trader can use. The margin-based leverage is equal to the maximum real leverage a trader can use. Since most traders do not use their entire accounts as margin for each of their trades, their real leverage tends to differ from their margin-based leverage. Generally, a trader should not use all of their available margins. Traders should only use leverage when the advantage is clearly on their side. Once the amount of risk in terms of the number of pips is known, it is possible to determine the potential loss of capital. As a general rule, this loss should never be more than 3% of trading account capital. So this is a thing where I think I read before in one of the lessons is like, don't risk more than, the maximum is 5% if you're ballsy, but you should always aim to go for a 1% capital loss. Well, not aim, but like the maximum should be a 1% of your account capital. If a position is leveraged to the point that a potential loss could be, say, 30% of trading capital, then the leverage should be reduced by this measure. Traders will have their own level of experience and risk parameters and may choose to deviate from the general guideline of 3%. Traders may also calculate the level of leverage that they should use. Traders may also calculate the level of margin that they should use. Suppose that you have $10,000 in your trading account and you decide to trade 10 mini USD JPY lots. Each move of 1 pip in a mini account is worth approximately $1. But when trading 10 minis, each pip move is worth approximately $10. If you're trading 100 minis, then each pip move is worth about $100. Thus, a stop loss of 30 pips could represent potential loss of $30 for a single mini lot, $300 for 10 mini lots, and $3,000 for 100 mini lots. Therefore, with a 10,000 capital and a 3% maximum risk per trade, you should leverage only up to 30 mini lots. 30 mini lots, even though you may have the ability to trade more. A stop loss of 30 pips could represent potential loss of $30 for a single mini lot, $300 for 10 mini lots, and $3,000 for 100 mini lots. Therefore, with a $10,000 account and 3% maximum risk per trade, you should leverage only up to 30 mini lots, even though you may have the ability to trade more. 30 mini lots. So 30 times 30, because $30 for a single mini lot, 30 mini lots is 900. Oh, you got 10,000 in your trading account, right? Okay. If you trade 31 lot, then you go to 99,000. No, 93,000. 33 lots 99. No, 33 lots 999. But then you don't include any of the fees and stuff, do you? So yeah, that's why they say 30, because then you could include some of the fees that go with trading as well. So leverage in forex trading. In the foreign exchange markets, leverage is commonly as high as 100 to 1. This means that for every $1,000 in your account, you can trade up to 100,000 in value. Many traders believe the reason that forex market makers offer such high leverage is that leverage is a function of risk. They know that if the account is properly managed and the risk will also be very manageable, or else they will not offer the leverage. Also, because the spot cash forex market are so large and liquid, the ability to enter and exit trade at desired level is much easier than in other less liquid markets. In trading, we monitor the currency movement in pips, which is the smallest change in currency price and depends on the currency pair. These movements are really just fractions of a cent. For example, when a currency pair is like the GBP USD moves 100 pips from 1.95 to 1.96, that is just a 1 cent move of the exchange rate. That is just a 1 cent move of the exchange rate. This is why currency transactions must be carried out in sizable amounts, allowing these minute price movements to be translated into larger profits. When magnified through the use of leverage, when you deal with an amount such as 100,000 USD, small changes in price of the currency could result in significant profits or losses. Currency transactions must be carried out in sizable amounts, allowing these minute price movements to be translated in larger profits. When magnified through the use of leverage, when you deal with an amount such as 100,000, small changes in the price of a currency can result in significant profit or losses. Risk of excessive real leverage in forex trading. This is where the double-edged sword comes in. As real leverage has the potential to enlarge your profits or losses by the same magnitude, the greater the amount of leverage on the capital you apply, the higher the risk that you will assume. Note that this risk is not necessarily related to margin-based leverage, although it can influence if a trader is not careful. The greater the amount of leverage on the capital you apply, the higher the risk. The higher the risk that you will assume. The higher the risk that you will assume. Note that this risk is not necessarily related to margin-based leverage, although it can influence if a trader is not careful. Let's illustrate this point with an example. Both trader A and trader B have a trading capital of 10,000 USD, and they trade with a broker that requires a 1% margin deposit. After doing some analysis, both of them agree that USD/JPY is hitting a top and should fall in value. Therefore, both of them short the USD/JPY at 120. Trader A chooses to apply 50 times real leverage on this trade by shorting US 500,000 worth of USD/JPY because it's 50 times 100,000, 10,000, based on their $10,000 trading capital. Because USD/JPY stands at 120, 1 pip of USD/JPY for one standard lot is worth approximately 8.3 USD. So 1 pip of USD/JPY for 5 standard lots is worth approximately 41.5 USD. 1 pip move. If USD/JPY rises to 1-to-1, trader A will lose 100 pips on this trade, which is equivalent to a loss of 4,150 USD. This single loss will represent a whopping 41.5% of their total trading capital. Trader B is a more careful trader and decides to apply 5 times real leverage on this trade by shorting 50,000 USD worth of USD/JPY, so same amount as the first one, based on their $10,000 trading account. That $50,000 worth of USD/JPY equals to just 1/2 of one standard lot. If USD/JPY rises to 1-to-1, trader B will lose 100 pips on this trade, which is equivalent to a loss of 415. This single loss represents 4.15% of their total trading capital. Table below shows how the trading accounts of these two traders compare after their 100 pip loss. Trader A, both of them starting with 10,000. Trader A uses 50 times leverage, B uses 5 times. Total value of transaction, Trader A is 500,000, Trader B is 50,000. In the case of a 100 pip loss, Trader A loses 4,150, Trader B loses 415. Trader A loses 41.5% of the capital, Trader B only loses 4.15. Trader A has 58.5% of the capital remaining, whereas Trader B has 95.8% of the capital remaining. So how does Forex leverage compare to stock trading? Leverage in the Forex markets tends to be significantly larger than the 2-to-1 leverage commonly provided on equities, and even the 15-to-1 leverage provided in the futures market. Although the 100-to-1 leverage may seem extremely risky, the risk is significantly less when you consider that currency prices usually change by less than 1% during intraday trading. Trading within 1 day, really? Currency prices usually change by less than 1%. Is that true? Are Forex markets volatile? Forex markets are among the most liquid markets in the world, hence they tend to be less volatile than other markets, such as real estate. The volatility of a particular currency is a function of multiple factors, such as the politics and economics of its country. Therefore, events like economic instability in the form of payment default or imbalance in trading relationships with another currency can result in significant volatility. Events like the economic instability in the form of a payment default or imbalance in trading relationships with another currency can result in significant volatility. How much leverage should I use? Traders should choose the level of leverage that makes them most comfortable. If you're conservative and don't like taking many risks, or if you're still learning how to trade currencies, a lower level of leverage like 5-to-1 or 10-to-1 might be more appropriate. More seasoned or risk-tolerant traders may be comfortable with 51 or 100 to 1 plus. Or use no leverage at all, if you want to be really safe. Anyways, the bottom line, there's no need to be afraid of leverage once you've learned how to manage it. The only time leverage should never be used is if you take a hands-off approach to your trades. The only time leverage should never be used is if you take a hands-off approach to your trades. So you're not doing it yourself? Are you trying to automate it? Is that what they mean? Otherwise, leverage can be used successfully and profitably with proper management. Like any sharp instrument, leverage must be handled carefully. Once you learn to do this, you have no reason to worry. Smaller amounts of real leverage applied to each trade affords more breathing room by setting a wider but reasonable stop and avoiding a higher loss of capital. A highly leveraged trade can quickly deplete your trading account if it goes against you, as you will rack up greater losses due to the bigger lot sizes. Keep in mind that leverage is totally flexible, customizable to each trader's needs. Smaller amounts of real leverage applied to each trade affords more breathing room by setting a wider but reasonable stop and avoiding higher losses of capital. Won't you lose more capital if you're using leverage? How can you avoid a higher loss of capital if you're using smaller amounts of real leverage? High leverage can quickly deplete your account if a trade goes against you. That's leverage trading done. So next one, Forex trading capital. So Forex basics, setting up an account. So this is Investopedia, not Parida, Investopedia, Forex basics, setting up an account, which I am going to do in the next video. See you later.